Hey traders, this is Blake Morrow with Traders Summit. With me today, I have Jim Welsh from Macro Tides. It's Friday. How you doing, Jim?
I'm doing good, and I'm happy and ready for a weekend, as I suspect you are too.
Yeah, I think we all are. You know, the thing about this market this week has been really headline driven, just has been moving the markets.
Yep.
And then also what we've seen is what we've seen is just a lot of consolidation in the markets. Although today, you know, being Friday, we're slipping in the markets a little bit here in the S&P,
Yeah.
you know, and actually the NASDAQ and Dow at the time of recording, we're at our lows, and we are approaching range lows in a lot of these indices. But you know, I just wanted to get your opinion on how you feel about, you know, all these headlines that are driving price this week. How do you feel about that?
Well, it's just the world we live in at times. There's just some periods where things are more calm and you're not blindsided by headlines. And then there's times like now where there seems to be almost every other day a headline that has a big impact on markets. And to me, again, it gets down to discipline, understanding where you're at, cutting back on size so that you're not, you know, really hurt by those things. And then, you know, being very disciplined in terms of using chart analysis and so forth, and have stops properly placed. I mean,
I mean, and I guess the really key point here is just making sure your position size is manageable, right? So if you get stuck on the wrong side, it doesn't hurt too bad.
Right. And because what the reality is in this kind of environment, we all have to be humble from time to time. We like to think we're smart and we're knowledgeable and all that. But there's, you know, the reality is none of us know what's going to happen in the future. That is the stark reality we all have to deal with. And I think obviously there's times like this that bring that point home in spades. And so again, to me, it just comes down to acknowledging that, hey, I don't know how this is going to turn out. Is Russia going in or not going in? How aggressive is the Fed going to be or not going to be? And in the meantime, you get the markets that you described at the very beginning, very choppy, and responsive to headlines. That's a really tough environment to trade. And that means there's times where, hey, backing away until this kind of craziness subsides is probably, from a risk management standpoint, a good decision.
Yeah, it's, you know, sometimes the best trades that you take are the ones that you don't take, right? So, you know, in this environment, like with the uncertainty, you know, as traders, we're not gamblers. We are looking at probabilities, and we're trying to find, you know, find an edge. Right now, it's hard to find an edge when markets are being pushed one way or another by headlines, which we have no control over, right? But let's talk about something that is maybe more of a, you know, something we should really talk about. Well, higher probability that the Fed is going to meet next month, but what should we be looking for with the Fed? Like, you know, between now and then, with the Fed, you know, coming in this next month, and we're looking to move on interest rates. What are your thoughts?
Well, we listened to Fed speeches. All right, that's important. From March 5th to I think the 25th, that's the blackout period before and after the next FOMC meeting on the 16th. So the next handful of days prior to the March 5th are important. I still believe the Fed is not going with a 50 basis point increase. There's a lot of good reasons for them not to do it. The primary one is they believe in forward guidance. They don't want to surprise markets. That's the whole point of forward guidance. So unless we see a real ramp up and more Fed governors and district presidents talking about a 50 basis point hike, it isn't going to happen. There was pushback. Bullard brought it up, and immediately there was pushback by 3 or 4 district presidents saying, I'm not there yet. Willing to talk about it, I'm not there. So I don't think the Fed goes 50 basis points. As you know, back in January, Goldman was talking about, well, we'll have a rate increase in March, June, September, and December. And my view back in December was that isn't going to cut. Fed is so far behind the curve, they're going to have to front load stuff and go March, May, June at a minimum. And now we're seeing people, including Goldman, they're going to hike at every single meeting this year. I think it's premature to make that estimate. I'm still comfortable saying March, May, June. So that
what would change your mind, Jim? I mean, we've seen all this, you know, all these high inflation prints. I mean, is there anything that would change your mind to say that they might actually go more than a quarter basis point?
only if they start talking about it. I mean, it's that simple. Like, I mean, people don't realize they put a great deal of emphasis on forward guidance. And so, and the whole point of that is to prepare markets for changes, which is why the Fed is always behind the curve as you enter into a tightening cycle. They're letting the markets lead the way. I mean, look at the 2-year, got up to 163, I think, and that's like 5 to 6 rate hikes. So now they're going to do it again. Unless they start telling us, and more governors and district presidents talk about the 50 basis point hike, it's not going to happen. Now, between now and the May meeting, or after the March meeting in May, again, you just have to take it one leg at a time. I just don't believe they're going to do that, because the data is going to get better in the second quarter because of reverse base effects. Some of the takeaway values from April, May, and June in 2021 are really high. So the CPI is coming down. In my mind, there's no question. Now, does it come down more than expected because supply chain issues, computer chip issues, begin to resolve at least moderately? And no one knows if that's going to happen until we get it, another 2-3 months from now.
Yeah, well, yeah, you're right. 2-3 months from now, but we do have, even today being Friday, February 18th, as we're filming, and even though most of you will be watching this either over the weekend or on Monday, President's Day, the fact is today we've got 3 voting members that are actually going to be speaking or are speaking, and they might lead us down that road.
Right, it's possible, but that is the key, is understanding what forward guidance means and how the Fed implements it. They're always going to telegraph what they're going to do ahead of time so markets aren't shocked. It's that simple.
It sounds like that makes sense, because I guess we're not living in the Greenspan era anymore. It's been a long time.
No, more importantly, the Paul Volcker era.
Yeah, right. Of course.
And many people, I'm sure, don't remember October.
I'm only a Greenspan trader, but don't remember Volcker. But that would make sense.
Yeah, I mean, Paul Volcker on a Saturday, October '79, announced a big rate increase. This was on a Saturday, so they referred to it as the Saturday night special, which is a reference, obviously, to a handgun. So you see how well the markets took that.
Yeah, right. All right. Anyway. Well, let's shift gears a little bit too, and let's talk about the S&P. So S&P is dropping to, we're at 4350 right now at the time of recording in the SPOOs. We've dipped below 4,300 a couple of weeks back. Do you think you should be chasing the market short here? And I know you got a chart that you want to show, but what are your thoughts with the S&P?
I believe that the bottom on January 24th was the end of either a wave 3, as I have notated on the chart, or a wave A of a much bigger correction. And because you can count only really, when you look at that, there's 3 waves down, 1, 2, 3. And now we're either in 4. Well, the problem I have with it being in 4 is that time-wise, relative to the amount of time in wave 2, has really extended. So to me, it's more likely what we're seeing is wave A bottomed on January 24th, and now we're in wave B. And I think it did an ABC up to 45.95. There's the small potential that we're seeing this lower low, because when I did this chart an hour ago, the S&P's low was 43.68, and now I think it got below 43.50. Yeah, there's still a chance if the Russian thing gets resolved over the weekend, the S&P is going to rally above 45.95. Conversely, if they go in, I think we're going to see the S&P decline. I'm sorry, as you were talking and we spoke earlier about events, this is the way it is in this kind of a land environment. So irrespective, my take has been consistently, we were going to get a rally and then ultimately drop below the January 24th low at 42.23 before the correction was complete. And I still believe that. Now, the route to get there, that's tough because of everything we've talked about. And you can kind of see on the S&P, there's a lot of volatility in really short periods of time. All right.
Well, thanks for pointing that out, Jim. I'm sorry?
Yeah, one last point is I believe we're going below 42.23. I think that ends the correction from 48.18. And then I believe we're going to new all-time highs in the second half of this year.
Okay. Well, I know you're sticking by those guns, and maybe this is the catalyst that drives us to that spike low that everybody can buy. So let's, but I'm gonna try to be optimistic, and I'm gonna look over at Treasury yields and say, but Jim, yields are still very, very strong. So what do you make of yields at this point and the bond market in general?
Yeah, I think yields are going to grind higher. I mean, months ago, my take was we were likely to see the 30-year get above 250 and the 10-year at a minimum get above 176. Well, obviously that's all. The 10-year has gotten well above 176. The 30-year is getting, starting to bear down on it. So I think over the next few weeks, we're going to see yields press higher until we get to the 30-year reaching 2.5%. And maybe a touch above that. Then I think yields are likely to come down for a period of time. Like, I mean, it's counterintuitive, but if I'm right, going into early March, you've got the ECB meeting on March 10th, the Fed's March 16th. There's still a lot of people talking about, oh, the Fed may do 50 basis points, may do 50 basis points. Well, if I'm right and they don't do that, and instead just do 25 basis points, that would be one thing that would help the market. Oh my God, the Fed isn't going to be as aggressive as we thought. And then we are going to see inflation numbers improve, as I said earlier, the takeaway value. So I think there's the potential Treasury yields peak in the month of March and then enter a period where they're going to be coming down for, maybe 2-3 months as inflation improves. And then we'll see what happens next. But that all a backdrop of why the equity market could potentially then rally to new all-time highs as the Treasury yields start becoming supportive as opposed to a big headwind.
So Jim, don't you think that, with the inflation data that is so persistently strong, with yields climbing, don't you think it's pretty amazing how resilient the broad markets, or let's just say the S&P and a lot of the let's say big cap names? I know we've seen a lot of weakness in some of the mid cap stocks, and we've seen a lot of stocks actually get cut in half and more. But a lot of these big names are really holding in there. I mean, how should we feel about that in light of everything?
Well, it's good, but the way I would look at it is if and when we see those stocks puke, that's probably the bottom. Okay. So that'll be the time that when those stocks start to give up the ghost, people are going to react, oh my God, they're getting weak now and all that kind of stuff. Well, a lot of other stocks, as you pointed out, have already declined by a lot. I mean, a few weeks ago, I had a table in one of my letters that showed, if you look at the average stock, the S&P was down about 18%, even though at the low, the S&P was down 12, the NASDAQ over 30% of the stocks were down, and the Russell was comfortably over 30%. So there's a lot of stocks that are down a lot already. And I've seen this often where you've got this group that hangs in, and finally they decline sharply. They join the party, so to speak. And that's the low. And I think something similar could play out here. In the next handful of weeks.
All right. Well, Jim Welsh, it's always a pleasure to speak with you. And I must say, love your work. If I want to find out more about you, how do I go about doing that?
Macrotides.com, or send me an email at jimwelshmacro@gmail.com. I'm happy to send a recent publication to you so you get a firsthand feel for exactly the specifics of what information I'm providing.
Awesome. And if you like what Jim has to say, make sure you give him a thumbs up on this YouTube video. Subscribe to our channel. It's free to do so, and so you don't miss any of Jim or my conversations on Fridays or any other interviews that we do throughout the course of the week. And also you can get to Jim's site just in, if you're watching on TradingView, Trader Summit, TradingView being the charts that I use. If you could go to Trader
It's
Summit,
Friday, man, and you're ready
it
for a
is
week.
Friday. You click his link there, his bio will take you over to his website. So guys and gals, thanks for joining Jim and I today. Jim, have a great remainder of your Friday and great weekend.
You do the same, Blake. Thanks so much.
Thank you. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.